Hi, everybody. Welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in today's video, we're going to take a look at the most common Roth IRA mistakes investors need to avoid at all costs, especially if they want to maximize returns and have more money come retirement.
Yeah, Michelle, we've talked a lot about the Roth on this channel, and I think it's to me, in my opinion, it's one of the best investment vehicles ever created because of its tax-free withdrawals of earnings in retirement. So, and today we're going to cover the top 4 mistakes, but make sure you stay tuned to the end as we're going to announce a 5th mistake that's commonly missed and very important to your financial wealth.
Awesome. Okay, before we dive in, if you like the content of this video, go ahead and hit that like button and make sure you subscribe to the channel so you don't miss another video from us on how to stop being a transaction, stop being sold, and become an informed consumer with a solid financial future. So, all right, Brian, let's dive in. It's not anybody who's watched this channel knows you love the Roth for the reasons you mentioned. So I'm going to put a link in the description below on Roth IRA Explained. Make sure you check that out. Whether you have a Roth now or you're looking to set one up, it's really important that you understand all the different aspects, the rules around it, and other than tax benefits, there's a lot of other things that go into it. All right, so let's dive in. What is the first mistake?
Michelle, the first mistake is not opening a Roth IRA.
There you go.
And this has got to be the #1 financial mistake to ever make out there today. You know, with Roth IRAs being the only 100% tax-free investment account out there, it makes sense to open one of these as soon as possible. There's 2 things in life that are certain: death and taxes. By opening a Roth IRA, though, Michelle, you can at least attempt to control one of these. So,
I mean, that's a bit, the tax advantage is a big thing. You know, imagine saving 20, 30 years, 10 years, whatever, it doesn't matter. I mean, it really makes a difference when you can pull that money out later in life.
Yeah, that's why I said as soon as possible to open one, because the longevity just accelerates your earnings in retirement. So,
all right, what's the second mistake then?
Second mistake is, after not setting one up, if you do set up one, not contributing up to the maximum. This is the second mistake that we see made with Roth IRAs. So think about this. For 2022, Michelle, the total contributions allowed are $6,000 and $7,000 if you're age 50 and older. But don't forget, you got till the next tax deadline to contribute to the previous year's Roth IRA. Don't look at it as a year to January to December. No, you got till next tax deadline. For this year, we've got till April 18th. So you can contribute up to the max if your modified adjusted gross income is less than $129,000 for someone that's single, and up to $204,000 for married filing joint returns.
Okay. All right. So number 3, third mistake.
Number 3, withdrawing from your Roth IRA too early. Very common mistake made with Roth IRAs. Okay, here's the rules. You're allowed a Roth IRA to be 100% tax-free and penalty-free. They're pretty firm rules from IRS, okay? You've got to hold the account for more than 5 years and be age 59 and a half or older. Withdrawals prior to age 59 and a half will be penalized 10% by the IRS, and you'll also have to pay taxes on the gains. Note though, one of the big advantages of the Roth IRA is your contributions are always allowed to be withdrawn. That's good to a point, but for some people, that's a hindrance because they know it's always there, that they can grab it if they need it, and then you lose the long-term growth of that account. So be very careful.
Which is the whole point really of having it, right? Is that long-term growth for retirement. Okay, so mistake 4.
Mistake number 4 is putting too much money in your Roth IRA.
Oh, yeah.
That's always a problem, right? This isn't too common, though, but it does happen. It usually happens, Michelle, because you're allowed to have unlimited amount of IRAs, okay? But your total contributions, go back to the number 2 mistake, is the $6,000 or $7,000 over age 50.
Total.
Yeah, in total of all them accounts, not per account. So it does happen though. And if you put in more than allowed contribution limits each year, you can be penalized by 6% from IRS per year for every dollar over that limit. And that's 6%, Michelle, for every year you leave the funds in there. So
Ouch.
be very, very careful. It doesn't
Right.
happen that often, but catch it as soon as possible. So
yeah, we've done a few videos recently on self-directed IRAs and how some people do have self-directed set up at the same time they have a Roth. And this is where it does get hairy, because if you're not counting that dollar amount, you know, I don't want to pay 6%.
yeah.
No, thank you.
No, thank you.
All right. So what's this bonus? What's the bonus mistake you promised us?
Okay. Now, thanks. First of all, thanks for staying to the end here.
Yeah.
If you're listening to this now, you're hitting bonus number 5 mistake. And it is, Michelle, not opening a spousal Roth IRA if you're qualified.
Yeah. This
So this is huge. We did a video on this topic specifically, and we'll make sure we drop it below this video in the description. Many don't understand that a stay-at-home spouse can open and fund a Roth IRA. A spousal IRA, Michelle, allows a stay-at-home husband or wife to open a retirement account in their own name.
And that's key, in their own name, right?
That's huge.
Yeah.
If one person, and this is common because if one person in the household has earned income and you file a joint tax return, you can open and contribute to this account. The non-working spouse, Michelle, can contribute as much to the spousal Roth IRA as the working spouse. This is huge. So,
but Brian, the key is they have to file a joint tax return. That's the rule. And that one of the two.
One has earned income and they file a joint tax return. You both can open a Roth IRA and fully fund it.
Okay. All right. So our contribution limits, let me ask you this. So for because it's in the spouse's own name, then there can be 6,000 if you're under 50 into spousal number 1 Roth IRA and 6,000 into spousal Roth IRA number 2. And if they're both over 50, then it's 7,000.
7,000 each.
It's not combined. It's separate because they're in different names.
It's in different names. And here's the key. You have to make sure that the amount of your combined contributions cannot be more than the taxable compensation that is reported on your joint tax return. So if you're both over the age of 50 and you put in $14,000, the allowed amount, you've got to show earned income of more than $14,000 is what IRS says. So,
all right.
That's it.
Perfect. All right. Well, thank you so much. Is there anything else you want to, anything else about mistakes?
Yes. Open one.
There you go. Great. All right.
Please open one.
You heard it here first, folks. All right.
And I will say that is investment advice. For the first time, you've probably heard that on this channel. That is investment advice. Go open a Roth IRA, please.
Okay. If you like the content of this video and you stuck around to the end, make sure you hit that like button. Also subscribe to the channel, hit that notification bell so you never miss another video from us. Thank you, Brian, so much. And thanks to everyone who made it to the end. Have a good one.
Thanks, everyone.